I just realized my bank account is mocking me. I'm looking at an interest payout of exactly 42 cents for the entire month, while the bank is out there lending my money to someone else at 7%. It's a quiet, invisible bleed that happens while you're busy trying to figure out how to cover next week's grocery bill. If you've ever felt that pit in your stomach when the credit card statement arrives and you realize you're just treading water, you're not alone. We're going to talk about a tool that, when used right, stops that bleeding, but when used wrong, can actually trap you in a financial corner just when you need your cash the most. By the time we're done, you'll know exactly whether locking your money away for a year is a smart move or a desperate mistake. I remember talking to a guy named Marcus last month. He was so fed up with his low-interest savings account that he dumped his entire $3,000 emergency fund into a 5-year certificate of deposit. He felt smart. He felt like he was finally doing something with his money. Then, 2 months later, his car transmission exploded. That 5-year lock? It cost him a 3-month interest penalty just to get his own money back. He didn't just lose the interest, he lost his peace of mind. He was right back to using a high-interest credit card to pay for the repair. That is the trap. Today, we're going to break down the math behind CDs, how the current Fed pause on interest rates changes the game for you, and why I'd personally rather keep my money in a high-yield savings account until I reach a specific safety milestone. Let's get real about what a certificate of deposit actually is. At its core, you're making a deal with a bank. You promise not to touch a specific amount of money for a specific time, and in exchange, they give you a higher interest rate than a standard savings account. It sounds great, right? But the math is where most people get tripped up. Imagine you have $5,000. If you put that in a standard savings account at 0.01%, you're earning 50 cents a year. A joke, truly. Now, put that same $5,000 into a CD at 5%. That's $250 in a year. That's a nice dinner out, or maybe a portion of a utility bill paid. But here's the catch, you cannot touch those dollars without a penalty. If you're living paycheck to paycheck, that liquidity is worth more than a $200 return. If that clicked for you, hit like. It tells me to keep digging into these boring but vital numbers. When does it actually make sense to lock your money in? It comes down to 2 questions. 1. Is this money part of my actual emergency fund? And 2. Is there a large, planned expense coming up in the next 12 to 24 months? If you're still carrying credit card debt at 22% interest, a 5% CD is a losing game. You're essentially paying the bank 15% for the privilege of them holding your money. I've seen people chase these small returns while ignoring the massive, burning fire of their own debt. If you have credit card balances, pay those off first. That's an immediate, guaranteed return on your investment that beats any CD rate on the market. Once the debt is gone, then you build your cushion. Let's look at the current landscape. We're in a weird spot. The Fed has paused interest rate hikes, and while that's kept CD rates relatively high for the moment, we're seeing a lot of volatility. If you think rates are going to drop in 6 months, locking in a 12-month CD right now might actually protect you. But if you're guessing on market direction, you're gambling. Instead of trying to time the market, focus on your own timeline. A CD is a tool for money you know you won't need. It is not for your maybe I'll need it fund. If you're a gig worker or your income fluctuates wildly, a CD could be a dangerous anchor. You need your cash available in a high-yield savings account or a money market account where you can withdraw it in seconds, not after filling out 3 forms and waiting for a bank clerk to approve a penalty. I want you to think about your own situation. Are you saving for a specific goal, like a down payment or a debt payoff lump sum? That's where the CD shines. I used a 10-month CD once to park a tax refund I knew I needed for a specific insurance payment the following year. I didn't touch it, the interest grew, and it kept me from accidentally spending that money on things I didn't need. It's about behavioral control. If you struggle to keep your hands off your savings, a CD acts as a guardrail. But be honest, is that your problem, or is your problem not having enough in the first place? If you're struggling to pay off debt, drop your biggest debt balance in the comments below. I read every single one, and it helps me understand what you're actually dealing with right now. You're not alone. Millions of people are fighting this exact same battle with their bank accounts. Now, consider the tax side of things. Most people forget that interest earned on a CD is taxable income. If you're in a higher tax bracket, that 5% return isn't actually 5%, it's significantly less after the IRS takes its cut. That's why, for many people, putting money into an HSA or a Roth IRA is a much more powerful move if they're eligible. You're getting tax advantages that a CD just can't touch. Don't get distracted by a shiny 5% APY advertisement. Look at your total financial picture. Is your credit card debt paid? Is your high-yield savings account at least 3 months of expenses? If the answer is no, forget about CDs for a while. Focus on the basics. It's boring, but it works. Hold on, we haven't even gotten to the part that surprised me most. Everyone talks about the interest rate, but nobody talks about the interest rate risk. What happens if you lock in a 5% CD, and in 6 months, the banks start offering 6 or 7% because of some new economic shift? You're stuck. You're watching from the sidelines while your money is locked away, earning less than it could be. This is why laddering CDs is a common strategy for pros. You take a lump sum and split it into smaller chunks, say 6-month, 12-month, and 18-month CDs. That way, some of your money is always coming free, and you can take advantage of shifting rates. But for someone just starting out, this is overkill. Keep it simple. High-yield savings accounts are currently offering rates that are very competitive with short-term CDs without the penalty risk. If you're sitting there wondering if you should be investing in crypto instead because you've heard about the rebound, stop. Crypto is not a savings strategy. It's an asset class with massive volatility. I've seen people lose 40% of their portfolio in a week because they needed to sell during a dip to pay rent. Don't gamble with your emergency money. A CD or a high-yield savings account is for preservation, not growth. If you want growth, look at index funds and ETFs, but only with money you don't need for at least 5 years. The confusion between saving and investing is the biggest reason people end up broke when they least expect it. Let's talk about that financial emergency feeling again. It's heavy. It's the constant math in your head. When I was in my worst financial spot, I spent every night looking at my bills and wondering which one I could push back another week. I wasn't thinking about compound interest or CD ladders. I was thinking about survival. If that's you, please understand that you can change this. The path out is slow, and it's not flashy, but it's real. It starts with building a buffer that no one can touch, and then using that buffer to stop the cycle of debt interest. If you know someone who's constantly stressed about their bank balance, or someone who keeps paying overdraft fees because they're juggling money between accounts, send them this. It might save them the 3-month interest penalty that I see people fall for every single month. It's a simple shift, but it changes everything about how you interact with your bank. If you're ready to see how a high-yield savings account compares to your current setup in real time, I've got a follow-up video called The Real Math: Why Your Traditional Savings Account is Costing You Hundreds. It breaks down the exact difference between the big banks and the online-only options that are actually paying you what you're worth. We'll go through the math, the fees, and the pros and cons so you don't have to guess. You've got this. Take it one step at a time, keep your focus on your own progress, and don't let the noise of the market distract you from the work you need to do at home. You're building a foundation, not a get-rich-quick scheme. And that's exactly how you win in the long run. Don't forget to check those comments, I'll be there.